Welcome back. There are new signs today that inflation remains a threat to the U.S. economy. As President Trump's sweeping tariffs take hold, it is time for a little money, power, politics. The Labor Department published new numbers on U.S. wholesale price today, and spoiler, they're much higher than expected. Fresh numbers from the economic front, they've painted a picture that is raising alarms across boardrooms and government offices. The latest data shows wholesale inflation climbing sharply last month, a move that could ripple into everyday consumer prices in the months ahead. Behind the numbers is a chain reaction. Businesses paying more for goods and services, supply lines tightening, and those pressures eventually spilling over into everyday prices. It's a shift that challenges forecasts, unsettles markets, forces difficult choices for companies and households alike. How long can these rising costs be absorbed? Bori, they hit hard at the checkout counter? And what will policymakers do if the pressure keeps building? Their report revealed a year-over-year increase of 3.3% in the price businesses pay, well above the 2.9% economists had expected. On a monthly basis, the jump was even more jarring, a 0.9% rise compared to an anticipated 0.2%. The surge spanned both goods and services. It's from products like food tow services such as air travel and hotel stays. The increases were broad and forceful. July's data broke from the more uneven movement seen earlier in the year, marking a sharp upward turn. This caught the attention of economists and business leaders alike. One of the most notable drivers was food. Price paid by businesses for food climbed 1.4% in a single month. Within that, freshened dried fruits and vegetables stood out, accounting for roughly a quarter of the total rise in goods prices. The causes here are complex. The United States imports a significant amount of vegetables, yet much of it comes from countries not facing heavy tariffs. That suggests other forces are at work, possibly labor shortages linked to immigration policy, volatile weather conditions affecting harvests, and higher transportation costs. WIC themselves rose in July. On the services side, transportation and warehousing saw steep gains. The trade services margin, the markup businesses apply, also increased, pointing to a possible shift in strategy where companies pass more off their rising costs on to customers. Travel and accommodations prices surged as well, rising 3.1% from June to July. That jump was especially striking given that June's levels had been relatively subdued. This matters because higher wholesale prices create a dilemma for businesses. If they absorb the increases, profits take a hit. If they pass them on, consumers face higher costs. Each choice comes with consequences, not only for companies and households, but also for the wider economy. Adding to the complexity, the Port of Los Angeles reported moving more than 1 million containers. In July, 8% increase from the previous year, annually trending up 5%. On the year in terms of imports that they're bringing into the port, the timing suggests many businesses rushed shipments to beat tariff increases that were set to take effect in early August. Even though there hasn't been a 90-day pause on some AFTO's tariffs, the preemptive surge in imports left a clear mark. According to port officials, this shipping rush was likely a temporary spike. They expect volumes to return to more typical levels for the remainder of the year. But this front-loading of goods also aligns with inflation picture. Businesses were buying heavily, often at higher prices to secure supply before tariffs added more costs. That kind of bulk buying can push up short-term wholesale inflation even if it temporarily keeps retail prices in check. The Producer Price Index, or PPI, is a key measure here. It tracks what producers pay for goods and services and serves as a leading indicator. For future consumer prices, the July numbers represented the largest monthly upside surprise in 3 years. That kind of unexpected jump complicates the work of the Federal Reserve, which has been weighing whether to cut interest rates to support economic growth. Treasury officials had recently August the possibility of a significant rate cut at the Fed's September meeting. But data like this makes such a move harder to justify. When wholesale inflation runs hot, Lowering rates risks stoking consumer inflation further, potential and the Fed's broader goals. The PPI also offers insight into the economic mood. While the Consumer Price Index reflects past price changes felt by households, the PPI looks ahead. It shows how companies are thinking about pricing in the future. The message from Dooley's report is that businesses see upward pressure on costs and are likely spurring to raise their own prices to cover them. The surge in imports ahead of tariff deadlines may have delayed some of this effect earlier in the year as companies relied on stockpiled goods. But now with those reserves running down, the pressure to raise prices could intensify. At the political level, the inflation debate has taken on an unusually sharp tone. White House officials have repeatedly pushed back against claims that prices are rising in recent weeks. The president, Hanley, criticized organizations and analysts who suggest otherwise. That included a pointed exchange with a leading investment bank over a report concluding that U.S. businesses have borne most tariff costs so far, but that consumers would eventually shoulder the majority. The bank stood by its findings, explaining that while businesses may initially absorb higher import costs, market dynamics tend to push those costs toward consumers over time. Their estimates suggested that by fall, consumers could be paying about 2/3 of the tariff-related increases. If those projections hold, the next few months could reveal the true scope of the tariff impact. Tensions over economic messaging haven't been limited to tariffs. The president has also questioned the accuracy of official labor data when reports failed to match his preferred narrative. Such disputes can create uncertainty, making it harder for businesses, investors, and consumers to plan. Parsing the current data is challenging because not all sectors are affected equally. Some industries like wholesale machinery manufacturing appear to be facing sharper cost pressures from tariffs than others. These sector-specific impacts shape the overall inflation trend in ways that broad averages can't fully capture. For companies on the ground, the picture is often clearer than in national statistics. Business leaders can see cost trends in real time within their supply chains, and their responses, whether to raise prices, cut costs elsewhere, or adjust sourcing, are what ultimately determine how inflation moves through the economy. In July's data, the machinery sector struggles were one clear sign of tariff impact. While food and transportation reflected other forces such as weather disruptions, labor shortages, and energy costs, those details matter because they point to where inflation pressures might persist, and where they might ease in the months ahead. The combination of strong import activity, surging wholesale costs, and political friction over economic data has created a complicated backdrop for policymakers. The Federal Reserve must balance the risk of slowing growth against the danger of letting inflation climb unchecked. Businesses must navigate unpredictable demand and volatile supply costs. Consumers meanwhile may find that the prices they face in the fall look very different from those they saw in the summer. This is not a moment shaped by a single factor, but by the convergence of many international trade disputes, shifting weather patterns, labor market strains, energy prices, and the strategic decisions of companies responding to all of them. Each plays a role in the trajectory of inflation, and each has the potential to alter the outlook in sudden ways. The months ahead will test how resilient both businesses and households can be. Wholesale prices area leading signal in July's surges suggests that resilience will lend. If past patterns hold, theftal effects will become visible as supply chain pressures filter down toaster shelves and consumers begin to feel what producers have been facing for months now. As discussed above, businesses have been absorbing the impact of Trump's tariffs for months, but the latest data shows that may be starting to change. Costs for producers and manufacturers climbed sharply in July, signaling that higher prices could soon make their way to consumers. New figures from the Bureau of Labor Statistics revealed that the Producer Price Index, a key measure of the average change in prices paid to producers, rose 0.9% from June, its largest monthly gain since June 2022, on a yearly basis. Wholesale price increased 3.3%. The jump came in fair above economists' expectations, which had called for a modest 0.2% monthly rise and 2.4% annual growth. The PPI often acts as a warning sign for what consumers may eventually face. And this report suggests a stronger inflationary wave could be forming. Economists pointed out that the PPI excludes imports, meaning the full inflationary effect could be underestimated. As one analyst studied, producers are beginning to feel pressure from higher tariff related costs, and it is only a matter of time for much of that burden is passed on to inflation-wary households. Markets reacted quickly at the opening bell. The Dow dropped 175 points. The S&P 500 slid 0.35%, and the Nasdaq Composite fell 0.3% before recovering some ground later in the morning. The numbers contrasted sharply with earlier in the week, when the Consumer Price Index for July had shown that falling gas prices help address train overall consumer inflation event. Goods sensitive to tariffs were still rising in cost. Some analysts described the PPI release as a jolt-tough narrative that inflation was easing. It underscored the possibility that ups for a guaranteed interest rate cut from the Federal Reserve next month may be premature. Traders scaled back their bets on a September rate reduction almost immediately after the report. Core PPI strips out the more volatile food and energy categories, also surged by 0.9% in July, pushing the annual rate to 3.7%, its highest since March. While PPI data are often more volatile than CPI, certain shifts are drawing particular attention. Much of July's increase came from these services sector, with purchase capital equipment prices spiking 4.5%. Economists noted that pricing pressure since concentrated in industrial goods targeted by tariffs are now spreading into services. This pipeline pressure means inflationary forces could be moving deeper into the economy. On the goods side, food prices were the main driver of the monthly gain, with agricultural products showing the most dramatic changes. Raw agricultural goods jumped 12.8% from June, and fresh and vegetables saw a staggering 38.9% monthly increase, the largest since March 2022. Analysts tied this directly to tariffs and Mexican agricultural imports, warning that such spikes could soon filter in a grocery store prices. These developments add weight to the argument against an immediate Fed rate cut. While Hotethanics expected inflation is important, some economists still believe the central bank will keep its primary focus in the labor market. The latest jobs report showed a gain of 73,000 jobs in July, well below expectations along with downward revisions to previous month's employment figures. However, the unemployment rate has held steady for much of the year, partly because the labor force itself has not grown significantly. Immigration policy changes have reduced the number of foreign-born workers, and retirements or disability-related departures among older workers have accelerated. This has kept labor supply roughly in balance with demand. Despite slower job creation, how these factors play out will be clearer in the August jobs report due in nearly September, which will weigh heavily in the Fed's decision-making. The PPI is only of several indicators that help track the health and direction of the U.S. economy. But the reliability of such data has come under scrutiny amid leadership changes and budget cuts at the agency that produces it. Following the disappointing July jobs report, Poseidon abruptly dismissed the commissioner of the Bureau of Labor Statistics and accused the agency of publishing manipulated data. Soon after, he nominated E.J. Anton, an economist at Heritage Foundation, to lead the bureau. Mintini drew criticism earlier in the week after suggesting that the monthly jobs report might be suspended temporarily to review its methodology.